How are you doing? David W. Williams, also known as Diamond Dave, founder of the highest paid part-time job in the World Option Training Academy, also known as the highest paid.online. Let me know you can hear me. Let me know what part of the country that you're coming out of. And what we're going to talk about is put contracts. So the title I use is how I use put contracts to scale from 0 to 100 mil in 10 minutes. That is not accurate, but I just use it to get people's attention. And because I was really piggybacking off of a term that was used in the kind of entrepreneur business space for a very long time, in which they use scale in every situation, right? And they kind of use scale as a way to say, here's how I exploded or exponentially grew this particular business, right? But what we're going to talk about is put contracts. And the reason why we're talking about put contracts is because first, most people are not really good at them. They don't really understand the concepts behind them. I've been shown and kind of separated myself from the pack by being very good at executing on the downside of the market. And executing on the downside of the market has a lot of limitations because first, a contract can never go under zero, right? Well, if you're trying to go for the upside of the market, a contract can go, a share can go into infinity. So let me repeat myself. Share price can never go under zero, but it can go into infinity. So already as a person playing the downside of the market, you're taking on a lot of risk to understand that there's a limitation or a bound that you can never get past because it can't go past zero. So it attracts a certain type of personality. It attracts people that can think a certain way. And it kind of discriminates against the average person because they really aren't comfortable in that particular space, because most people, the way they're conditioned, they want to always be on the side that they think has the unlimited growth potential, right? Whereas playing the downside of the market, you already know where things are going to have to stop because they're going to have to stop with zero. So then your attitude is that how can I get as much as I can get within this particular limit or within this particular parameter, right? And for a long time, when I was trying to really understand how the market worked and when I started studying options, the put side didn't really make sense to me. I didn't understand it conceptually. But then once I started to understand it conceptually, and then because I really understand what's really going on in the market, it became very easy for me to execute on these particular plays. And to be real with you, when we're in a bullish market, it's easier to find downside plays because of the way in which the market is structured. It's harder to find downside plays when the whole market is bearish. So that's why last year it can start to become difficult because people are bearish across the whole market. But when people are very exuberant, they're very euphoric, it's easy to find downside plays based on how this particular market is set up. And I think a lot of people, and it's not as if they have to see things the way I see things, but I often wonder, do they really understand how the market is actually constructed? I'm not talking about a conspiracy theorist. I mean, like, do they really understand how companies go public? Do they really understand the goal of financial media in supporting these institutions? And then once you really understand that, you kind of understand the game that is being played, and then you can operate a lot better because you understand the game that's being played. So what we're going to do in this particular video is for people that are watching that are not really accomplished at put contracts, I'm going to kind of give you some principles that I go by. This is not going to be a process, but what I want you to do is take some of these principles and use them to create your own process, right? Now, if you want to learn more about this type of information and really kind of understand what I'm talking about, I have like 1-hour videos, especially like on Carvana, where I extensively break down what helped create my bearish narrative and to give you a better understanding that you normally wouldn't get through mainstream media. Because once you really start to understand these markets, you got to ask yourself, why are they letting CEOs come on news shows and promote their company? And it's because if they don't have any content, right? So everybody is in the same, everybody's on the same side of this charade. And it very much is a charade. But you have to have that level of interest in the financial system, and not just from a trivia standpoint, but really want to understand the plumbing of the financial system to understand how these things work, right? And so this show is being sponsored by www.thehighestpaid.online. It's an options trading academy. We've been very successful in helping people get the life that they desire by leveraging the financial markets, what we call the derivatives market. And my majority of my experience is as a derivatives trader and then teaching people how to do it, right? And we've shown to have a lot of success because what makes us different than what everybody else does is I don't teach what everybody else teaches, right? And people that stay around me long enough start to understand, my perspective and why it's different and what some of the things they can pull out of it to get their success. Because I'm not teaching what you can go catch on YouTube or what you can watch by watching, CNBC, even though I do tell people to study financial media, because I'm not on board with, right, just entertaining people or trying to just get eyeballs. The goal is to put people in position to be successful. So that's what we teach there. So you can learn more about what we're talking about on this video if you go tap into the particular course. So let's go ahead and get into the content before it gets too late. So these are some of the things that I look at when I'm looking at a particular company to be bearish on it, right? So what's the overall narrative of a company? Now, the reason why I'm looking at this is because I'm trying to determine, do they have the ability to perform, right? The goal of a CEO is to convince investors that they have a path to success. That's their job, right? And I think people, I don't maybe because I may come across very cynical. A lot of it has to be with what I've been through in life. I've seen things in life that the average person hasn't been exposed to. So it may create a level of cynicism in me. But I think for some reason, people want to believe a lot of times what these CEOs tell them. I don't know why, right? Like, I don't know why you don't believe people in your family, but you believe some person on television that you don't know. It's weird to me, but that's me. Everybody's different. So what I'm looking at is what's the overall narrative of a company? And do I believe they have the ability to perform that narrative? Right? Because what we saw, let's say 2 years ago, everything was EV, EV, EV. Now everything's AI. It was EV, then metaverse, NFTs, then now it's AI. So if you notice, the narrative changes every few years. Well, when everything was EV, 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 and the average person was promoting the EV space and telling me how EVs are going to take over, yada, 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 you started seeing all these IPOs and SPACs come out that were EV focused. So anybody remember the three-wheeler EV? I forgot what it was called, but like, the three-wheelers, they look like motorcycles, but they're really three-wheelers. The three-wheeler EV, I forgot the name of it, was going to do the light delivery, kind of like the Sprinter vans. They had an EV deal. It was a lot of different like EV deals out there, right? Everybody knows about NKLA, which was an EV. It was supposed to be hydrogen powered. But we saw a lot of companies come into that particular space and try to take advantage of that momentum. And there's a lot behind that. And I would be on here for 2 hours talking to people, and I probably won't ever tell you to it for free because that information is worth money. But there's something going on here that makes these things happen, right? It makes these things happen. And it happens over and over and over again. It'll never stop until this financial system that we're operating in stops. But what you've got to understand is that Tesla had first mover advantage in the EV space, even though they're not the first EV company. But they were the first company in a very long time that invested a lot of money in the EV space. Then once people seen that was a valuable space to raise capital in, because of the way in which I would say the societal trends are going, we're going more towards a clean energy environment, or what people are perceiving to be as clean energy. There's anything anybody can do about it. That's the way the world is going. So they realized, I can raise money in this particular space. The question is, do they have the ability to pull off what they say they're going to pull off? Because what happened is, once Tesla blew up, everybody was looking for the next Tesla because they didn't want to buy Tesla at that price point. So what they do now is they start becoming open to believing that this particular company is going to be the next Tesla in their space, and I can get in real cheap, like people that got into Tesla 8 years ago, or even 10 years ago. There was a time when Tesla was trading for $60 a share. I'm talking about pre-split, right? Tesla, without splitting, would still be probably trading around $2,000 a share. And so people start to believe that I'm in on the ground floor of this very radical, revolutionary type deal. And I believe that the CEO is going to get me there, right? The question I want to ask is that, do I believe they have the ability to do it? And sometimes they do. There's a company called QuantumScape, and I talked about this with GC. They went public, no product, no sales, right? But they were able to IPO. So they went IPO with no product, no sales. They just did an offer yesterday after earnings because why? They're running out of money. because they still have not even built a product to take to market. So do I believe that the CEO has the ability to not to first build a product that actually works and then be able to develop a business around a product? Because just because you got a product don't mean you have a business. But because they're trading for $9, they used to trade a lot higher than that. And they're in my course, QuantumScape. Because they're trading for $9, people will throw money at them because why? It's only $9. If I have $1,000, I can buy X amount of shares, and hopefully in the next 5 years, they can go from 9 to, $10 or $20 or $50, and I've doubled and tripled my money. And that's how people think. But the question is, does that particular person have the ability to do it? Right? The overall narrative of a company, do I believe they can pull off what they say they can pull off? I don't buy into this is the trend. I don't buy into total addressable market. None of that is relevant. Right? These are all terms that are used to miseducate or persuade the financially illiterate. The total addressable market for water is billions of people. Does that mean I should invest in a water company? What's the total addressable market for toilet tissue? It's billions of people. Does it mean I should invest in a toilet paper company? What's the total addressable market for, let me think of something else. Alcohol. Does it mean I should buy into a spirits brand? Right? So total addressable market, these catch terms and buzz terms that people use to make you think they know what they're talking about, it doesn't mean anything because the total addressable market for water is billions of people. But it doesn't mean that a water deal is a good deal for me to invest in. Right? And so that's what I want people to really understand. The next thing is going to be operational. How do they run their operations? Do I think that operationally there's holes or there's challenges the way they're not going to be able to be successful? The next thing is the industry. What do I think is going to impact that industry on a negative standpoint? So do I think that there's some type of legislation that's going to come down that's going to negatively impact that industry? Right? Because it doesn't matter how good operations are. If the industry is going to change, it's going to impact that particular operation. Right? And that's going to therefore change that narrative. So those are some of the things that I look for from a macro standpoint, right? That kind of gives me an idea. And it doesn't mean that it's going to go the way I think it's going to go. Because often, and we talked about before, the way this financial system is set up, they have to put money somewhere. So often money will stay in a deal that's bad because they really have nowhere else to put it. And because they were able to get in at such a low cost point, they don't care that it may sell off a little bit because they still got in way cheaper than anybody else was able to get in. That's how these type of deals work. Let's go to the next one. What's the technical narrative? Previous resistance in a chart pattern, right? So if I'm looking at technical narrative, is the chart showing me something? Is the chart starting to break down? And you can see this with certain deals. Is the chart starting to break down? Are people starting to sell off that company gradually? And I use platforms like FinVits, but sometimes FinVits doesn't catch it. Or maybe I'm looking at, I'm doing my searches wrong. But you can sometimes look at a chart of a company and you say, you know what? This thing has been selling off the past year, but it was very gradual. It was 3% a day. No big moves that really stand out on scanners. 3% a day, 3% a day. Did it have one day where it may recover 5%? Then did it have another 5 days where it'll lose 3% a day? You look up 180 days later and it's lost literally 200 points, right? So that's a technical pattern. The previous resistance, is it failing at previous resistance points? So let's say it went up, it sold off, and now as it's trying to retrace back up, it's hitting that old resistance and selling off again, which means that people are not convinced that they want to buy it at that higher price. So is there a chart pattern that can kind of show me that the market is bearish on this particular ticker, and maybe I need to do some further investigation? Okay, what's the next one? Unusual options activity. Now, what I mean by that is there something standing out on the options chain to where I think somebody's taking a bearish position for whatever reason? And it doesn't mean that's going to be 100% incorrect, because everybody can be wrong in this market. It doesn't matter how much money you have. So you can see a large amount of activity on an options chain. It doesn't mean that things are going to go that way. It means that somebody may know something and is taking a bearish position. You see this in the market all the time. There was it Binance? I think that's the name of the company. the SEC came down on Binance. What somebody did that same day was bought millions of dollars of put on Coinbase. They bought millions. That same day, that I think that was on a Monday, that they came down on Binance. It was early in the week if it wasn't Monday. Somebody that same day bought millions of dollars of puts on Coinbase. The very next day, the SEC came out on Coinbase. Coinbase sold off very aggressively. That person exited their play. So either somebody had great insight on the deal or what was going on, or they just knew something. But for some reason, as soon as they came out against Binance, somebody bought millions of dollars of puts on Coinbase. Right? Very next day, SEC comes out against Coinbase. Coinbase sells off. So sometimes you can see unusual options activity on a chain that can let you know somebody believes something's getting ready to happen. Is that 100%? No, it's not, because it doesn't matter how much money you have in this market, you could be wrong. Right? But these are the things that stand out. Right? Let's go to the next one. Volume. So when I'm looking at volume and selling higher than average volume, when a company starts to sell off, I'm looking at its daily volume. Is it selling off higher than that daily volume? Because that means there's a lot of conviction in the sell-off, right? Based on how markets actually function. So the question you want to ask yourself, and this is help you answer that question, what is the goal of a market? Let me put that in there. Right? So when you're looking at this, you want to ask yourself, what is the goal of a market? So when I'm looking at a sell-off, what I'm looking at is so conviction in the sell-off is that the sell-off is greater than average volume, right? It means that a lot of people are trying to get out of their position. And so what the market maker is having to do is to generate a lot of transactions to keep the sell-off, how do I say it? Regular. That's not the proper term. But what the market maker doesn't want to do is to have the stock price just do this. Okay, it's not in the camera. Have the stock price just do this. He doesn't want that. It's not a good look for the market. They prefer a gradual. So what you see a lot, and you're seeing that now with these companies missing earnings, is they're gapping down on earnings and then they're trading sideways. The next day, they're gapping down even more, they're trading sideways. The next day, they're gapping down even more than they're trading sideways. They prefer that than to open up and to just go all the way straight down. They don't really want that. You saw some of that last year. And so I'm looking for volume that's higher than the average volume to show conviction in the sell-off, right? And then what I'm looking for is as that continue to go on. So what's the average volume the first day? Okay, it's greater. The second day, how is it in comparison to the average volume? The third day, how is it in comparison to the average volume? Because what you'll see over time is that the selling volume will get less and less. So it'll close red on the day, but the volume will start to get smaller and smaller, which just means people that are going to exit have pretty much already exited. Because one thing you got to understand about every market, once everybody that's bought has bought, there's nowhere else for it to go but down. Once everybody that's sold has sold, there's nowhere for it to go but up. Therefore, you don't want to come in once everybody has sold off, because once everybody sells, it's over. So you saw this with Bitcoin last year. Bitcoin got between like 15 and 20,000, and it wouldn't drop any further. Why? Because why? Everybody was going to sell it had already sold it. They weren't going to sell it lower than that. They just weren't. So it traded in that range for a very long time, and it started to work its way back up, because in any market, once everybody that's going to buy has bought, there's nowhere for the market to do is either to stabilize and trade sideways or to go down. And once everybody that has already sold has sold, there's nowhere for the market to do but to trade sideways or to go back up. And it's more likely to go back up than go down. Once everybody, because now if people believe the price is cheap enough, they'll start to come back in. That's how markets function. Right? And the question you want to ask yourself is, what is the goal of a market? Right? And people don't really understand. It's not to make money. It's not the goal. The money is a result of the goal of the market. So once you understand that, then you kind of understand why you see sell-offs at higher volume. So let's go to the next one. Total collapse from news. So like, let's say news comes out and it just totally collapsed. And I believe that that's going to be extended over the course of so many days. And you get that with certain tickers. In the pharmaceutical space, anytime somebody's drug doesn't go through, it sells off. Right? So you got to realize that sometimes news will create a collapse. Sometimes it doesn't, though. So it's not 100%. So if your process is going to be, I'm going to wait for the news, just make sure you got a process based around that. You may want to have some other technical indicators to confirm what's going on, because sometimes you get bad news and things don't sell off, right? Because it's all about positioning and market sentiment at the end of the day. Technical collapse, right? So that'd be like short attacks or profit taking. So sometimes you'll wake up and a company will just be selling off. And it's because that shorts have decided to attack it that day, right? They decided this is going to be our day where we're going to sell this particular ticker very aggressively to make money. Or you're going to get profit taking. So we talked about before, once everybody has bought, there's nothing else to do now but sell it, because everybody has bought it. They bought it. They rolled it up. There's nothing else to do but sell it now. So you're going to get days sometimes where you're going to get massive profit taking, where everybody that bought it earlier is selling it now. And they're looking for people to sell it to them because they think it's still going to get ready to go up, but they're ready to get out of the deal, right? And so that's what you got to understand, is that these things can happen. They're just like technical collapses. You'll see them on the chart. And you want to try to determine whether this is going to be a one-day deal or there's going to have some legs to it, which means that's going to happen multiple days. Okay? So here's some of the traps that people can fall into that can put them in a position to not be successful. FOMOing into a play late. So, you may catch something late on the scanner, on the chart, and then now you just want to get in on the deal, so you come in late. The problem is that the volume of selling is getting ready to end, right? But you just FOMO in late. And then what happens is that it consolidates or it starts to reverse and you get caught on the wrong side of the play. And so that's why you want to encourage people, especially when they start out, is to focus on a set number of tickers that you know, so you know what's going on with them, so you don't come to the party late, right? Because whether you're playing upside or downside, if you get there late, you can get stuck holding the bag. Let's go to the next one. High short volume to float. What I mean is that we're seeing this with Wayfair. We saw this with Carvana. A lot of those companies that got really beat up last year, they had a high short percentage. But what happens is that once people start taking the opposite side of it, it starts to move up, because why? Shorts have to cover. Right? So when you're looking at these companies with 40% short, 30% short interest, they can be very volatile to the upside, because if there's any upside movement, shorts are going to have to cover based on how short selling works. Right? And then them covering creates more demand on the ticker, which means what? It starts to move up even more. Right? So if you're going into a ticker that's been beaten down for a long period of time and it has a high short percentage, you want to always be aware that it can go opposite of the downside because of how high the short percentage is. And you got some people, they just look for these type of tickers. It doesn't always go the way they think it's going to go, because they swore that like GameStop was going to make them a millionaire, and it hasn't happened yet. But people got to understand these are very volatile plays to the upside because of the way the market functions. So if you're coming into Wayfair and its short percentage is 35 and 40%, you want to know that any positive news, any any buying pressure on that stock can make it go up because of how high the short percentage is, and then it becomes a feedback mechanism, right? Now, some tickets get shorted into the ground over time with a high short percentage, but it doesn't always work that way. And to be real with you, companies don't go bankrupt until they run out of money. They don't go bankrupt because their stock price is low. People don't understand that. So as long as a company can get more liquidity into the deal, they can keep going. So you can see a situation like Carvana was $4 at one time, and now it's trading at 50. Because why? They was able to get access to liquidity, which means what? We can keep the company going. Which means what? People start buying back into the narrative because they're not going to run out of money. Because you're not bankrupt until you run out of money, right? As long as you got money, you can't go bankrupt. Under 50 mil float, that's not for rookies. So this can be dangerous. You're in a deal where the float is very small. Now, what's dangerous about that? because the float is very small, which means that's how many shares available to be traded. Any buying pressure makes the stock very volatile because there's not a lot of shares available anyway, right? So it's a difference between Apple or Amazon where you got over 1 billion shares. So if somebody comes in and they put an order of 250,000 shares in, it's not that big of a deal. Well, if you're trading something with 20 million shares and somebody comes in and over the next 10 minutes, they want to get 1 million shares, that's a big part of the float. It's what, 5% of the float, right? So it can make that float very volatile. So if you're trying to play the downside and it's a smaller float, you got to always be aware that this thing can reverse very quickly with any kind of buying pressure because there's not enough shares to absorb any buying pressure. You don't have to really buy a lot of shares to move the float, right? It's a lot of shares to us, but it's not a lot of shares to somebody that has the capital to do that. And so that's something that you want to be aware. It's not for rookies. If you're playing in tickers that have very small floats, and I mean, for this example, under 50 million, you want to make sure you know what you're doing because you can get caught on the wrong side of that particular play real fast. Illiquid tickers, not for rookies. Another thing, tickers that often have small floats, but don't trade a lot over the course of the day, which I mean under 1 million shares a day. Those are very illiquid tickers. If you look at those tickers, there's a big spread between the bid and the ask. And the bid is what somebody's bidding for, what somebody's bidding to buy, and what somebody's asking for to sell. Often with illiquid tickers, you're going to see a big spread between the bid and the ask, which makes the price jump over the chart. So you look at the chart, the price will jump to different spots on the chart. It's not a very organized selling pattern because why? It's not a liquid ticker. So those aren't for rookies. If you don't really know what you're doing, as an options trader, you're going to get filled very badly because the spreads are going to be very wide, because the spreads on the shares are very wide. And it can also be very volatile because you don't necessarily know where the price is going to land at because it's not a liquid ticker. The volume is very low. The market maker is moving the price to try to find buyers or sellers, but because there's not a lot of people in that market that want to even transact, the market maker's having a hard time finding buyers or sellers. So what they're doing is they're just moving the price everywhere, trying to find that activity, right? Because that's the goal of a market. People got to really understand the reason why markets are created. A low volume options chain is not for rookies either. So low volume options chains where there's not a lot of volume on that particular chain, open interest or volume. So the spreads are very wide. You're going to buy at the ask, you're going to sell at the bid. There's a big spread between the bid and the ask. So you're going to probably overpay to get in the deal because you got to buy right at the ask to get in. And then when you go to sell, you're going to sell it at the bid, which means that if the spread is very wide, you're not going to get filled properly. So even if you're right, you could potentially lose money on the deal. So it's not for rookies. It's the people that understand what they're getting themselves into. They know how to manage the situation properly, and they know how to exit and not take a big loss, right? Because they know that this is a very dangerous, volatile, illiquid situation, right? So I wouldn't tell rookies, people that have traded probably under a year consistently, to even just leave that alone. It's not going to be for you, right? All right, Katrina, we'll get up with you and be safe out there. So that's pretty much going to be how I use put contracts to scale from 0 to 100 million in 10 minutes. Hope y'all got some value from it. And this is just going to be some basic fundamentals to help you create your process. The good thing about the downside of the market is that it teaches you how to make money regardless of what direction the share price goes. But you got to some limitations to be in it because you can't get past 0. So no matter how badly a company performs, you can't get past 0. And let me add one thing in that I forgot on the slides. When a company gets under $10, it's less likely to continue to fall. Because why? It's so cheap, people start to buy it. Or there's automatic buy orders put in by firms to buy at a certain price. So when a company gets under $10, it's more likely to trade sideways or go up than is to keep selling off. Can it sell off? Yeah, it can, but it's less likely because there's only 10 points between 10 and 0. So it only can fall so much farther. Now you will get some companies that are sell off, and then trade at that number horizontal for months. It can happen. It happened to Hertz. But as an options trader, what you're looking for is volatility to the downside. So it trading sideways don't help you. So if it's at $4, where else can it go? It can go to $0. It can go to $1. It can. But you needed to go from $0 to $1 in like one day. What's the likelihood of it doing that? It can do that though. So when I'm looking at a ticker to be short on, once it hits $10, I kind of want to stay away from it because what I need is for it to collapse. That can happen. I was trading this ticker called GSX one time. I think it might have been a little over 10. And then what happened is the Chinese government banned their business, and it went from it closed at like 10 and opened at like 7. So you got a massive move off the open. So the contracts had to readjust. There's a lot of profit in those particular contracts, but I was out of that deal because I wrote it down from 100. So that's what you want to understand. Another thing, believing companies are going to go bankrupt. I could do a 2-hour video on why it's almost impossible for a corporation, a publicly owned company, to go bankrupt. So we may believe it's going to go bankrupt, but with that being the narrative of why we're short, can be very difficult because it's very difficult for a company to go bankrupt. They will figure something out to get some more money in that deal, right? Because AMC was on their way to bankruptcy, and they came up with some type of, scheme to get retail to buy into it so they could dilute retail and get more liquidity. And that's how this thing works. So those are 2 other additional things you want to watch out for. So hope you got some value from it. We're going to go through these comments. We're going to go through the super chats, and we're going to get up on out of here because I wasn't going to be here long. So Ray Gun, man, appreciate the $2. Tor Helms, man, appreciate the $2 super sticker. Right? So Miss Islaw, appreciate you coming through. I think you told me what I was in Washington again. What's going on, Tor Helms? What's going on, Ramel Stanley out in South Korea? I know somebody that was in the military, was an Air Force, used to live out there. What's going on, Katrina? I know you say you had to leave, but I appreciate you coming through. What's going on out there in Texas? Jason Wood, what's up with it? Katrina says, my Facebook timeline is empty from all the options gurus from 2020. Most definitely. A lot of them have switched into doing something different. They're trying to sell something different to their audience. It is what it is. And that's how this game works, man. People try to ride the trend, and when they feel like it's not hot, they don't want to ride it anymore. But the thing about options is that they was here before we was born, and they're going to be here when we're gone. No, the derivatives market's not going anywhere because the options are a public derivatives market. Then you have private derivative markets like credit default swaps. So derivatives markets aren't going anywhere. They're going to always be here, in my opinion. Yeah, it was Workhorse. It was Workhorse. It was other ones too. It was a list of them, but Workhorse was one of those EV companies. And Katrina says it's being repeated with AI, most definitely. So AI is a new narrative now, right? GC, what's up with it? So the goal of a market, in my opinion, is to facilitate transactions, right? So with the goal of a market being to facilitate transactions, the job of the market maker is to try to push the price in a place that's going to facilitate transactions. That's what they get paid to do, right? So sometimes they get paid and they get compensated with stock, and they will use stock and options to do that, right? From an equity standpoint. Then the futures is a different game. So the goal of a market is to facilitate transactions, right? So you want, the way we do it in the equity game, they get paid per transaction. So they want more transactions. So they're trying to do volume. You could have a different market where you get paid a lot for each individual transaction, so you're not tripping on volume. But in the equities market, they get a piece of every transaction. So they get paid off the number of transactions, not how much each transaction is worth. They don't care about that. So their job is to create volume. So the goal of a market in this particular perspective is to generate transactions, to get transactions, right? So Katrina says Ford recalls regularly, leads the way. Yeah, definitely. So Miss Phoenix says Yale is an example, 21.9 million float. Yeah, that's a small float. It's a very small float relative to like other companies. So it can be very volatile to either side. So if I'm short and any good news comes out, and I heard that they're going to get a financing deal so they don't have to go bankrupt, because like I said, it's hard for a publicly owned company to go bankrupt. You know, somebody will give them some money if they have revenues coming in the door, right? It's easy for a person to go bankrupt. It's hard for a company to go bankrupt. That's publicly owned. So I would be wary because of how small that float is. If any buying pressure comes in, it's going to push that stock opposite in the opposite direction, especially if it's buying shares and people buying call options because of delta hedging. So then I could get pushed out of my position relatively easy. So those are things you got to watch out for, right? Now, big floats often don't move. Like you look at Coca-Cola, Pepsi, they're like, you know, big ocean liners that don't move fast. But the reverse of that is really, really small floats, and it's very volatile to the upside if you're shorted. But it also, if somebody decides to come in and sell it, it can be very volatile to the downside. So that's all we're going to talk about. Appreciate everybody for coming through. Make sure y'all stay safe out there. And like I talked about before, is that this is not investment advice. It's not a process. But what I wanted to teach you is that these are some of the things that I look at, and you may be able to take some of this and implement this into your process and what you do and put yourself in the best position to be successful. Y'all be easy, man. Talk to y'all later.